Greetings, fellow investors. I'm Matthew Cochrane, a lead advisor at Seven Investing, where it is our mission to empower you to invest in your future. We do that by providing monthly stock recommendations to our premium members and educational content that is freely available to everyone. Listeners, today I am very excited to introduce Perth Tolle and welcome her back to the show. Perth is the founder of Life and Liberty Indexes. It is the home of the Freedom 100 Emerging Markets ETF, ticker FRDM, a first-of-its-kind strategy that uses personal and economic freedom metrics as factors in its investment process. Perth was a private wealth advisor at Fidelity Investments in Los Angeles and Houston. Prior to Fidelity, Perth lived and worked in Beijing and Hong Kong, where her observations led her to explore the relationship between freedom and markets. We had Perth on the show a little more than a year ago, and since that interview, I believe her strategy has only been validated more. We're going to get into that. I can't wait to talk to her again, so let's get to it. Perth, welcome to the show.
Thanks for having me, Matt. It's great to be back.
Of course. Perth, let's just start with this. I'm not sure when this show is going to come out, but we're recording on February 24th, 2023. Do you know what this is the anniversary of?
Of course. So it's the anniversary of Russia invading Ukraine last year.
That's correct. So 1 year ago today is the day that Russia invaded Ukraine. And while that certainly came with many concerns and global concerns for the world and horrible human tragedies, one down the stream effect of it was that in the preceding weeks following that, there was a lot of emerging market ETFs that were exposed to Russia, and they had a lot of headaches with this. I mean, these are just clips of headlines that appeared in the weeks following the invasion. If you're watching on YouTube, if you're just listening on the podcast, but just reading some of the headlines, emerging markets ETFs are in uncharted waters with Russian stock trading on pause. Your portfolio might be more exposed to Russia than you'd like. Wall Street fund giants face headache as indexes dump Russia. And then, of course, about a month after the invasion, we had the headline: emerging market ETFs swing from net asset values as Russian securities valued at zero, which basically was MSCI's decision to remove Russian securities from its emerging market indexes at a price of zero. Perth, you run an emerging markets ETF. Did you have these problems with your ETF?
We did not. We did not have any exposure to Russia, China, or other autocracies that are heavily exposed in the emerging markets indexes that you're talking about. So we were fortunate in that we never were exposed to those countries.
Now, so why don't you tell us why that is? Why don't you have exposure to Russia? Because I think it was about a 3 to 4%, an emerging market index, 3 to 4% of that was exposed to Russia.
Yeah, and that's a crazy situation that happened, and a lot of people didn't see it coming, but autocracy risk is real and it was always there. People, I think, just chose to ignore it because most of us that work on Wall Street are in financial centers in the world, such as New York, London, Hong Kong, places that maybe aren't as exposed to the risks that everyday people experience in emerging markets, especially. So the emerging markets universe is just full of autocracies. It's by nature countries that are either autocracies or coming out of autocracies. There's a huge divergence in freedom levels in the emerging market countries. You have the very free countries like Taiwan, South Korea, Chile, Poland, and then you have the very unfree countries like China, Russia, Saudi Arabia, Egypt, Turkey, so forth. So it's just a huge divergence in freedom levels. So when I was an advisor at Fidelity, I had a lot of clients that wanted to invest in China, but didn't know, what was actually going on the ground there. Kind of just blindly went in. And then I have a lot of clients who came from these other countries. For example, I had a Russian client who said to me, I don't want any exposure to Russia because it's like funding terrorism. And look how prescient that is now in light of today. And in fact, it's funny that you bring this up because today, even now, a lot of funds I think Amundi in Europe just delisted some of their Russian ETFs. So we're still dealing with the repercussions of this in the ETF space around the world. And so what we wanted to do is create a way for investors to get emerging markets exposure, broad emerging markets, diversified exposure without those autocracies, but also to give them a higher exposure to the freer countries, because we believe that the freer markets will outperform in the long run because they have, more sustainable growth instead of debt-driven, state-mandated growth. They have faster recoveries from drawdowns, and we got to see that in live performance in the second half of 2020, where the freer emerging markets outperformed, broad emerging markets. It outperformed emerging markets ESG, and it outperformed even emerging markets ex-China. So it's not just a China story. And the freer markets, they tend to allocate their capital more efficiently. So it's not one central planner telling you how to allocate capital. It's actually people on the ground, deciding how best to add value. And so we believe that the freer markets will, in the long run, outperform, and we don't want to fund autocracies. So what we did is, instead of market capitalization weighting, which is the standard weighting mechanism in indexes and in the emerging markets, gives you a very high autocracy concentration. So instead of that, we do freedom weighting, and we weight according to a country's level of freedom. So we look at both personal and economic freedoms, and we get these data from third-party think tanks like the Cato Institute and the Fraser Institute.
So we're going to pick up on that thread in a minute, but I wanted to start our conversation there by highlighting the long tail risk that maybe some investors overlook, since we've basically lived in a time of relative peace and prosperity, and in our U.S. bubble, especially for U.S. investors, where we're just so used to the rule of law and the protection that gives us. We might forget that not the whole world enjoys freedom like we do in the U.S. Sure. But I do want to pivot here, and let's just go back a little bit. Let's start at more a basic level. When we talk about an emerging market, what are we talking about exactly? What are we talking about when we say emerging markets? What is an emerging market? Yeah, so an emerging market is typically a less developed kind of, if you think about third world country. Again, we don't determine these classifications. The country classifications in the indexing world is determined by the big indexers like MSCI and FTSE, mostly MSCI. So 95% of the world's institutions benchmark to MSCI indices. And so MSCI has country classifications for each country. There's three main types of country classifications for international stocks. There's developed markets, and that's your bigger markets like UK, US, Canada, Japan, Germany, and so forth. So those are countries that are all very developed, have very open capital accounts, very open trade, movement of people and capital across borders, and so forth. So very reliable banking systems. So it's the countries that are already pretty free. So if we do freedom weighting in developed markets, it would add very little value, because all of those countries are very free and homogenous in their freedom levels. And then you have the emerging markets. So emerging markets are countries like China, Russia, Saudi Arabia, Brazil. I think people used to use the BRIC acronym for this, which the BRICS acronym is pretty much dead at this point. There was like no cohesive commonality between those countries, except that they were all coming from a very low base. And then there's some very free emerging markets, which some would argue should be developed, like Taiwan and South Korea. So those are what are classified as emerging markets. So they're smaller than developed markets. And there's some of them they're not as open. They're not as easy to move capital across borders. They're not as, they don't have as strong institutions and so forth. So those are emerging. And then you have the frontier markets, which are even smaller than the emerging markets. And these are countries like Kuwait, Vietnam. Those are some unfree ones. Some very free ones are like Estonia, Latvia, Lithuania, Uruguay, and so forth. So those are frontier markets. So we are focusing on the emerging market space, which is the middle of the three that I just mentioned. And because this is a very large allocation in a lot of investors' portfolios, and there is such a high divergence in the freedom levels between these countries. This is a result of some quick Googling, but I believe emerging markets, the population of emerging markets is about 4.3 billion, which is more than 50% of the global population. It's about 50% of the global GDP. The last decade, I think it's the result of 66% of global GDP growth. But it's only equities in these countries only represent about 15% of the world's like securities market cap.
Yeah.
US investors like ignore these markets too much and at their peril.
Yeah, those are some great stats that you just Googled there. I think this is something that, our friends, Rob Arnott and Med Faber have always said, is that we are under allocated to emerging markets, given their contribution to world GDP, given their population growth. And we're talking about the ones that do have favorable population growth. There are some very large emerging markets like China that have very unfavorable population situations. But given all of that, it is an underallocated asset class, according to, if you match up those stats that you just mentioned to the actual allocations that we give them. But yeah, most US investors I know have between like 12 and 20% in the emerging market space.
So now we started off our conversation. Let's like pick it up where we left off, hopefully. But like you talked about how the Freedom ETF differs from other emerging market ETFs. But is this a moral cause, Perth, or is there like will this have a negative impact on investors' returns?
Yeah, so we have the fortunate situation right now of having almost 4 years of live ETF history, live fund history to look back on, and then even longer than that for live index history. So what we've seen during that time is extremely stark outperformance by the freer emerging market set of countries to the broad benchmarks. So yeah, as you're showing here, there's a 20% or 20% gap, performance
significant
gap.
outperformance.
Yes, and that's great to see. And what we like to be is a scorecard for the freer countries. Now, I want to caution here your investors. Do not expect this every year. There are going to be times when, for example, China is 35% of EEM, the other fund that you're showing here, which is the benchmark for our fund. And when China outperforms because it's 35% of that fund and 0% in our fund, we will underperform if that happens. And you saw in the beginning of 2020 that is exactly what happened. So there are, if you zoom in on that, periods of underperformance. But if you look at since inception history, it is a very stark outperformance story for the emerging markets that are more free. And I think that makes sense, but also it's stark because of all the extreme events we saw in the last few years, COVID, the war. This is not something that we would expect every year, although there's always something in emerging markets.
That's probably accurate.
Yeah.
And even more so we can talk about your ETF's outperformance, which is like I just said, I believe that is fairly significant outperformance. But even more than this, and we talked about this same chart last year, and it blows me away. I don't know how you can deny this, but when you look at a country like China, which has by all definitions experienced economic growth the last few decades, where their economic growth has exploded. And yet when you look at shareholder returns over that time, it doesn't even come close to matching that. I guess, let me just put the question to you. Why is that? Like, why can't shareholders capture any of this economic growth?
Yeah, so this chart is an extremely good illustration, and China is always exhibit A of what we're talking about because of this. You saw, like you said, very real growth in the last 3 or 4 decades in China. I mean, people lifted themselves up out of poverty after the artificial restraints under Mao were removed. So China went from extremely bad policies under Mao, where tens of millions of people died in famine, to not so bad policies. And that incremental change in economic freedom allowed this tremendous growth in the country and created this kind of economic miracle. But investors were not able to capture any of it. And you see that in emerging markets, especially emerging markets like China, because of expropriation. There's, the companies in China, the ownership structures are very murky and non-transparent, very opaque. Same thing with accounting standards, very opaque, very non-transparent, does not meet international standards. And you don't really know when you invest in China who that investment is benefiting. So we are not sure, who all the owners of these Chinese companies are. So if you look up, any Chinese company, look up the ownership, you typically see only 60% of the owners. And so we don't know where the other 40% is. And a lot of times investments in these companies directly benefit, party members or people in favor with the government and their friends and other, people, their associates. So one is we don't know where the money goes when we invest in a country that has very poor transparency and poor economic freedom. And the other is these companies in China, they are not free to put their own interests above that of the state. So companies that operate in a way that have to put state interests above the interest of, say, their customers or their shareholders.
And that can change. And that can change at any time too, right?
Yes.
I mean, like the state can say like, now these are our objectives, but then at a second's notice, right? They can tell video game companies, oh, wait, if you're under this age, you can't play video games except for 1 hour a day. Or if you're a Chinese educational company, you can't charge the market rate of what you could charge for.
You're a nonprofit now.
Right.
Yeah, so we saw that happen just in the recent past, where companies were restricted from raising capital. They were restricted from conducting their core business activities. They are restricted from making profits. So this is a very poor way to capture growth, because when any of those three things that we just mentioned happen, and they've all happened recently, the company's value basically goes to zero, and it's not recoverable until the government says, okay, you can make profits again. Or, like you said, it is very capricious. And so that capricious government action risk and the risk of you're subsidizing companies that are doing business in this manner, which there's a cost to doing business this way. It causes that, that return to be siphoned off to state actors or other people who are not actually the foreign investors in these companies.
Right. It's like, to say the least, like shareholder returns is not, it's not, the China government does not care about your shareholder returns.
No, and that's something that we realized in the last couple of years. It's not something that we knew before, I think, as an investor community.
Yeah, no, I think that's accurate. It's I'll say this, it's certainly something I've realized in the last couple of years where I did not realize it before. And for those, I always forget to do this, but if you're listening on the podcast, the chart showed China's GDP growth was over the last few decades, basically 3,300%. And the MSCI China index had shown a total shareholder appreciation of 47% in that time. Perth,
which is about 0% on an annual basis. It's between 0 and 2%.
It's amazing. It's amazing how paltry those returns are.
Yeah. It's literally worse than treasuries. Really, really, really bad.
Yeah. China, man, there's a lot we can talk about China, but so China, if you're invested in like an MSCI index or another emerging market index, China is like a huge part of those economic market indices. We've already indicated that the Freedom ETF does not hold China. Like, how does China rank on the human and economic freedom scores?
Pretty poorly. So I can look those up, but it's somewhere around 150 out of 162. Out of the emerging market country set, it is almost the worst. So it's like the only one that's worse is Saudi Arabia. So you have Saudi Arabia at the worst out of the 24 country emerging markets universe, and then China, and then Russia. So it's actually, Russia ranks higher. So it's very bad. And that's both personal and economic freedom. So there are countries in the emerging markets country set like Saudi Arabia, Qatar, UAE, who rank higher on economic freedom, but very poor on personal freedom. So especially women's freedoms, right? So that's one-sided, but in China, it is two-sided, like it ranks poorly across the board. And so especially I would say personal freedom, but it's very, very poor personal and economic freedom. We use a data set that has 83 variables that measure personal and economic freedoms. And I categorize them into 3 different categories: civil, political, and economic. So civil freedoms are things like terrorism, trafficking, torture, disappearances, women's rights, right? So China has 30 million missing women due to the one-child policy. And that's official Chinese think tank estimates. Some out there have it as twice that. That's not recoverable in my lifetime. So that's a huge demographic time bomb that is starting to go off now, exacerbated by COVID and everything else that's going on there. And that's why they had the education companies say, you have to be nonprofits now because the cost of raising a child is high. They're trying to encourage people to have more children due to the lack of population growth due to largely the one-child policy. And so, reproductive freedom is a personal freedom. Shareholder rights are an economic freedom. And they're trying to basically fix one by adjusting the other. You can't do that. Freedoms are like parts of an automobile. You can't fix a transmission by tearing out the steering wheel. It doesn't work, right? So that's what's going on there. And so we look at all of these measures of freedom, civil, we discussed, political are things like freedom of speech, expression, media, assembly, civil procedure, criminal procedure, so on and so forth, judicial independence. And then economic freedoms are things we're more familiar with, like private property rights, rule of law, contract enforcement, business practices and regulations, freedom to trade internationally, soundness of the money supply. So all of these things added together, we use the composite country score for each country to derive our country weights.
Now, so I would say, so economic freedom is fairly obvious, right? Why that's important to sticking to an investing mindset. Like, obviously economic freedom is important, but it might not be as obvious why personal freedom is important. Why are both together needed? Why are both important?
So yeah, this is why my data providers say, the freedoms are like parts of an automobile. You need every part of the automobile to work for it to run. Sorry. Oh my gosh, sorry. I just edit out this part with my cat. Okay. You want me to remove him here? Let me. Oh my God, let me remove.
No problem.
There's another cat outside. He's trying to. Okay. Sorry, you're gonna have to edit that out. Hope you can do that.
No problem.
Okay.
But yeah, so why are personal freedoms as important as economic freedoms? Because I think it's fairly obvious, right, to investors, and strictly speaking, in terms of investor returns, that economic freedoms are important. But why are personal freedoms important to shareholder returns?
Yeah, so personal freedoms are part of that rule of law and the environment in a country in which all its citizens dwells, right? So right to life, for example, if you don't have life, you can't produce economic returns. So that's important. Women's rights, right? If you have 30 million missing women in your country, or women who don't have rights, can't get an education, can't drive, can't go out of the country without permission, can't participate in economic activity, then that is half of your basically citizenry that are not going to be productive on an economic standpoint. Things like contract enforcement and rule of law, criminal procedures, civil procedures, freedom of speech, media, and expression. Those things are important because if you don't have freedom of, for example, freedom of the media, there is no independent verification on any of the data that comes out of companies or governments. Again, China is a shining example. If you don't have, free media, every year the Chinese government will say our GDP was 7%. Every year that happens, and no one contradicts it. If you contradict it, you're disappeared, or So it's extremely important for all of these types of freedoms to work together to create an environment that incentivizes true productivity and growth. If you don't have one kind of freedom, you essentially can't use the other. It can't be half free. Economic freedom, as you said, is also very important because we're in the kind of investing world where we care more about economic freedom, but I also work with activists like our partners at the Human Rights Foundation who focus very little on economic freedom and mostly focus on personal freedom. But I have to remind them, look, if you don't have the freedom to make a living, this is how the Arab Spring started, right? If you don't have the freedom to provide for your family, unless the government gives you that privilege, you have to be one of the favored few to be able to have, economic kind of permission to provide for your family, then you don't have freedom. If you depend on the government to tell you that you can have a job, that you can have a fruit stand, that you can participate in the economy, then that is not freedom. So you're not free, even though you can, assemble or have freedom of religion or freedom of speech. All the freedoms have to work together, like the parts of an automobile. If you don't have a steering wheel, but you have a transmission, the car's still not going to run.
And not just, you give examples of small business owners like fruit stands or a restaurant or something like that. But like in China, it was even like Jack Ma, right? The founder of Alibaba, like a year ago, it was like, oh, he disappeared and oh, he's under house arrest, or oh, it's where is Jack Ma? Is he still in control of his company? And you just had all these rumors come out, and he was, in America, he would have been closer to being celebrated, like an Elon Musk or Jeff Bezos.
Exactly.
In China, like it was like he could seemingly be removed from the multi-billion-dollar company he founded, like at a moment's notice.
Yeah, so no one is above the law in China. You've had celebrities who are, akin to like Nicole Kidman, like in China, Fan Bingbing was disappeared and then, hit with a like multi-hundred million tax bill. So basically she had to pay a bribe to get out of disappearance. And she just now recently, and that was like maybe 5-6 years ago. And she just now recently did another movie for the first time. Right now, Bao Fan, who is he's a tech titan in China. He's an investment banker who had his hand in every important tech deal in China in the last however many years, and everyone knows him. He is currently missing. So this is headlines right now. Bao Fan is missing in China. His company has been unable to reach him. Nobody knows where he is. So it's like Jack Ma before he's resurfaced, right? So that's where Bao Fan is right now. I mean, this is insane. And there's been reporting by FT that Bao Fan was moving his fortune to Singapore from China at the time of its disappearance. So he was already seeing the writing on the wall. He was trying to move out, and they got him before he moved. I mean, it's insane. And disappearances like this are one of our metrics. So no, you can't conduct business in a way that is benefiting your shareholders if you're concerned about becoming disappeared, if you offend the government, right? So yeah, it's obvious when it happens, but before it happens, nobody even thinks of it as a possibility.
So when you remove a company like China from your ETF, you're removing a company with several high-profile companies, high-profile tech companies. I mean, you talk about Alibaba, Tencent, JD.com. I mean, you're talking about like some of the world's biggest companies. Can you still have, when you remove a country like that, can you still have like sector diversity across from the emerging markets? I know, at least from my limited knowledge, that emerging markets, a lot of them are heavy in financials or natural resources, commodity type businesses, energy. But can you still have sector diversity by removing a country like China?
Yeah, actually, you get better sector diversity with a freedom weighted approach, because the freer countries tend to be the ones with more diversified industries versus just relying on one natural resource, right? So Russia is like, I'm sure everyone's heard, it's like it's like a military, it's like a gas station with the military, or I forgot what the actual phrase was, but it's something like that, where it's just oil, and that's it. And, there's no other industry. Saudi Arabia is very similar. But with the freer markets, they have more diversification in their industries, and they're not just bound to one natural resource. You have countries like Taiwan with no natural resources, right? Yet, if you look at a chart of Taiwan's growth over China's in the last decades, it's 5 times the stock market growth, just looking at the stock market index. So, investors captured 5 times the growth in Taiwan versus China. And all everyone talked about in the last, decade was China. So yet, as we saw on your chart, they captured no growth there. So yeah, you actually get better diversification. Now, we don't have as many, we do have a lot in tech, but the kind of tech is different. So we have a lot of semiconductors, right? So we have Taiwan Semiconductor, we have Samsung. We actually have to cap those companies because they take up such a large part of their economies in those countries. So we have a security cap at 8%. So at the time of rebalance, they have an 8% weight in the index, and that's their maximum rebalance weight. So we do have a lot of kind of the semiconductor type of tech, and not so much the some of the frankly frothier, more bubbly names in the past couple of years. So that actually helped us. So we'll see if it continues to help us, but you do actually get a very, very diversified industry set in a freer country exposure.
So we talked a lot about China and Russia. I think those are some of the more obvious names when you're talking about countries that might score low on human and economic freedom scores. Are there any other countries that are that are scored particularly low and that investors might not be aware of?
Yeah, I think most people are aware of most of the countries that score low now, but Turkey is one that has had a lot of trouble lately, and a tragic situation with the earthquakes there recently. But they were the only country that has ever triggered our methodology rule that says if a country falls more than 5 points on the Freedom House scale, then in any given year, then it is kicked out of the index or it's excluded, even though it was previously included. So Turkey triggered that rule in the 2018 rebalance, because remember, the index existed since 2017.
Right.
The fund existed since 2019. In 2018, Turkey triggered the freedom decline momentum rule and was excluded. It has never made it back in. And during that time, you see this huge decline. And that's to catch these very quick declines in freedom levels. We found that when freedom increases, it happens very gradually, but when it decreases, it can happen very quickly. And so we want to catch that very fast decline before, it's like it's like a stop loss.
Gotcha.
And so basically it triggered the rule in 2018, never made it back in. And we've seen Turkey just continue to see extreme declines in their freedom levels from that point on. And we were able to sidestep that due to the freedom decline momentum rule.
How often do you, like in a situation like that, let's talk about Turkey, like how often are the rankings updated? Is it this an annual thing, a quarterly thing, or is it like live in real time? How quickly can you rebalance?
It is annual. So because we are using third-party data by the Cato Institute and the Fraser Institute, they are also using third-party data from 100 think tanks in their freedom network around the world. So there's 2 levels of third-party objectivity, but that also causes this kind of, it's not real time, right? It is an annual situation. And also it's slower than even some of the other data providers out there. So Freedom House, for example, is a little faster than Fraser and Cato just because they're not a transparent methodology. They're kind of a black box where it's a committee making these decisions. Gotcha. Also, they don't cover economic freedom. So it's just political freedom, basically. And so we wanted a comprehensive data set that covers all freedoms, personal and economic, the economic part being half of the metric. So very important. But to have this transparent methodology, it does cause a little delay in the data coming in. So it is annual. And so we rebalance annually. But what I have seen is that this works that way. So it doesn't have to be real time. And that was one of the concerns that was brought up to me when I first created the index by colleagues in the freedom econometrician kind of community. And they were like, well, obviously it's not going to be real time. So, is that going to work? Because stock market reacts in real time. And what we found is that it takes a couple of years actually for policies to affect markets. And when you have an instant reaction, like with elections, it's often priced wrong. So what we've seen is that, for example, Poland, right, elected the PIS government around 2016, and they gained constitutional majority, and they rolled back some of the very important freedoms like judicial independence and women's freedoms over the next several years. It coincided with the Trump years in the US. And the year before that happened, or as it was happening, we had a freedom meeting with a lot of these 100 think tanks. The Polish delegate was there, and he spoke to me, and he said, hey, I know you have a lot of Poland in your index. I just want to tell you, we're about to elect this kind of crazy, super extremist government, and they're going to, do some crazy things, and it's going to be bad for, these freedom metrics, but it won't show up in the market for several years. And it happened just as he said. 2016, 2017, so 2016, they come into power. 2017, Poland is the top performing emerging market and number 1 in our index. 2018, they dropped to number 4. And they've remained at number 4 since then. So it took a couple of years for these policies to show up in the markets and show up in the scores. And so that has been the way that a lot of this has worked out. We included Brazil a couple of years back. When India dropped out, Brazil got bumped up, right? So it wasn't Brazil's score, that changed. It was India. But anyway, it was, they're both very borderline countries. And Brazil, people were concerned about the changes there, with the government as well. Again, took a couple of years for it to affect markets, and it's still in the index now. So those are just some examples of, it does take a while for actual policies to be enacted on the ground to actually affect economic conditions on the ground.
Gotcha.
So until that happens, we don't make changes.
Okay. Yeah, I can see why there would be a lagging indicator there. You mentioned,
I would say it's still a leading indicator. So freedom is still a leading indicator, but there's a lag in the data from, when we expect a policy change to when it actually affects markets.
Gotcha. You're right. You said that better than I did. You mentioned India. That's often the other, for lack of a better term, like economic powerhouse, or at least potential economic powerhouse that people think of when investors are talking about emerging markets. I don't think it's happened yet, but I think they're expected to exceed China in population sometime in the next few years. How does India rank on your freedom metrics?
It's about in the middle. So it's borderline country between the 24 countries. It's like number 13. So it's India is a very interesting market for me. I love India. It was in the index when we first launched the fund in 2019. And we have a lot of fans in India of our strategy. And I think that comes partly from the India-China rivalry, right? So we don't have China, so India likes us, that type of deal.
Right.
But also I think India is a high potential market, extremely high. And the demographics are extremely favorable. They also have some, similar to China, they have a son preference, which means there is a lot of bad things happening to baby girls and so forth, just like in China, but it's not as bad, and it's not like forced by the government. But the problem that we're encountering in the scores with India, we've always encountered problems with their trade score. So their freedom to trade has always been lower than other, relatively low than the other, more free included markets, because they've had high trade barriers, both tariff and non-tariff trade barriers. So they're a very protectionist country. And in the ETF world, you see this as well. It's extremely difficult to trade, Indian stocks. And open that account in India. It's extremely difficult. So most in our index has this rule that we only use ADRs in India, right? So most indexes will have that rule, and you'll see that because it's very difficult to access those local stocks. So that's economic freedom, but also we've seen in the past several years, and this is how they dropped out of the index. They had increased repression of the Kashmir people, which is a territory that they control. They had more coercion of the media, and we'll talk about that in a second. And they blacked out protests a couple of years ago in places that had, they blacked out the internet in places that had protests. Like they were expecting farmers' protests, that they blacked out the internet so no one would hear about it. Press freedoms recently, they raided the BBC office because there was a documentary done on Modi. This documentary was also banned across college campuses, universities, and so forth. So this is extreme coercion of the media and expression. And, this is not something that we expected to see even, in India. And so it was surprising that it was this blatant, but, things like this caused their score to go down. And as far as India, like after we're talking about the war, when Russia invaded Ukraine, and they've been, they haven't been as clear as the rest of the countries around the world to say, okay,
right,
we're with Ukraine, we're going to sanction Russia. Whereas the rest of the world was very clear. It was a very clear, coordinated effort on the part of the West, all the allies, to do so. China obviously was, on the other side of that, and India kind of trying to be Switzerland, like they're,
right.
so it's been very disheartening what's happening there. But I have huge hopes for India. I love India as a country, as a market. I think it has huge potential. I think much better potential than China. And I don't want to equate, what they're doing with, for example, the Kashmir people with what China is doing, for example, with the Uyghurs. No comparison, but still, it's you have to be relatively freer in the emerging markets universe to be included, and they're currently barely not. So it's a borderline country. It could be included at any time. Every year I expect it, but we haven't seen it yet.
Now, I think, correct me if I'm wrong, I think you said another borderline country that is currently in the index is Chile, and was even responsible for like some of your outperformance the last year or two. But
so
it might be in danger of not making the index anymore.
No. So Chile is not a borderline country. It's
okay. I'm sorry.
Very high freedom country.
Okay.
But it is a very small country. So in MSCI based indexes and funds like EM or IEMG or even VWO, which is FTSE based, it has less than 1% weight typically. But in our index, it at rebalance time had 18% weight. Last year, that weight went up to as high as 25. So the reason why is that, so Chile is interesting in that, freedom, kind of the freedom community, especially the economic freedom community, looks at Chile and is seeing just a huge risk because they recently elected a new government that that people were concerned would roll back their business-friendly policies that Chile has enjoyed for many years, and that led to their prosperity. So this new government has been in power since December of 2021. Over the course of 2022, because they have such a high weight in our index, a lot of our clients, I got a lot of emails about this, we're very concerned. And, but, we go by the scores. So, we follow, it's literally a rules-based, methodology follows the scores. And so we still had a high weight in there. And I said, look, just have to see, how it goes. It's a test of their institutions, and their institutions tested well last year. None of the referendums put out to a vote were voted in. In fact, they were very voted out on a very high margin. So Chilean voters came out and very adamantly said, we do not want these policies that would be anti-business. We like these business friendly policies. And they came out and voted in droves for that. And I have Chilean friends here in the United States who, live, for example, in New York, and they went down to Miami to vote, against these referendums. And so, so I think what we saw in Chile is, they elected, the branch of government that was very anti-business. And there are still, to this day, a lot of concerns about, can we keep up that economic freedom as the, beacon of economic freedom in South America, in Chile? But so far, we've seen their strong institutions, at play, and they have not enacted any of those policies that are suggested by this government. And we'll see how it goes going forward. But typically in the freer emerging markets, there are stronger institutions, there's stronger rule of law, there's more respect for, individual rights, shareholder rights, and so forth. And that makes them kind of the safe havens in a crisis situation. As far as,
And again,
yeah.
No, I was just gonna say, and again, you said this was in a typical emerging markets index. Chile is
1%.
1%, and in your index, it's in the
18%. And
18%.
and last year that added a lot to our returns, because Chile has a very diversified commodities exposure. So they're world's top producer of copper, lithium, and so forth. And they strongly outperformed in the inflation trade. And not only that, but this year to date, we're seeing strong outperformance in Chile again, partly because, ironically, of China, because they do a lot of trade with China. And remember, we don't penalize free trade. We actually think the freer the trade, the better, right? So because China had a reopening bounce, Chile benefited from that as much as China did because of that trade. And it's a way of kind of participating in a bounce and even these unfree markets without that direct autocracy risk, where the company, the government can come in and tell the companies, oh, you're a nonprofit now. We don't have that risk in Chilean companies. They can choose to do the trade, or they cannot do the trade, right? They can trade with this country, or they can trade with another country. So they call the shots. They are free to do what's in the best interest of their shareholders. And as a result, when they do trade with these unfree markets, we can benefit from that trade without direct autocracy risk.
We talked about so many negative countries. I think Chile is a great positive note to end on. Perth, if people are interested in the Freedom ETF, or if they're interested more in following you, where can they find more information?
Yeah, so the index site is lifeandlibertyindexes.com. The fund site is freedometfs.com, and I am on Twitter at Perth_Tolle.
And we'll include those links in our podcast notes and in the article on the site accompanying the episode. Perth, thank you so much for joining us again.
Thanks for having me.
Listeners, again, I'm Matthew Cochrane. We're 7 Investing, and we're here to empower you to invest in your future. Have a great day.